Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. John, great to be with you today. Thanks so much. And joining us, everybody, of course, is John Zechner, a very well-respected money manager here in Canada. Many years of experience, which I think is so key and critical these days, John, isn't it?
Yeah, it really, sometimes you hearken back to days long ago. It's almost with his oil thing and all of that. I was reminded back of 1990, the Operation Desert Storm and what happened with oil prices back then. So yeah, having a long history sometimes helps in this market environment, that's for sure.
It does. And, okay, so everybody knows, I think by now, that this is the top 5 at 5. So your top 5 stock ideas. But John, I do think, and I am going to ask you to kind of give us your macro overview, because I actually saw it was a tweet that you put out in terms of the price of oil and likening it back to Desert Storm. And I think you thought that the price of oil is going to go down today, which it has been doing. But I wasn't, when I read your note, I wasn't sure that I fully agreed, quite frankly.
No, so Catherine, you know what? That's one of those things of being right for the wrong reasons. And I mean, it wasn't a daily call or anything like that. My only point is you have to watch it as you know, in the market, once an event gets well anticipated, when the event actually occurs, markets go in the opposite direction. And that was my point, that back in 1990, there was a whole occupation, obviously, of Kuwait. And then when Operation Desert Shield actually launched in August of that year, that was when oil prices peaked around $40. They headed south from there and never saw the light of day till 2005 when they crossed that level again. So it's just when you get caught up in the moment like that, it's like a Fed meeting or anything else. Like, as you know, the market tends to do the buy on rumor, sell on news. So that's my only point I was making about that. I think we constantly have to be aware of this, and particularly in a volatile environment like this.
So let's extrapolate then a little bit further before we get into the stocks. When you talk about and your ability to reference the past, what are you most focused on right now? Is it the Fed, I would think, or is it geopolitical issues, as we were just kind of mentioning?
Yeah, geopolitical, I think, always goes further down the list to me, Catherine. I think in the end, there's two drivers of markets. I mean, two things really matter, and it's really monetary policy, the level of interest rates, because that tells you what the P is going to be in your price earnings ratio, and earnings, and that's obviously, driven economically and all of that. In the end, I think that's really all that's going to drive stocks up and down. The rest is sort of, to some degree, noise. And the issues I have a little bit in the short term is to some degree those things are starting to work against you. Like, certainly the idea of the on the price earnings ratio, it has been so driven by this 12-year downturn in interest rates to zero, and to the degree we're turning that up, you're taking that tailwind away, and clearly you've seen that in the past year. And particularly in the past couple of months, as we've seen these growth stocks or higher valuation stocks start to roll over in that type of environment. But the other, warning flag is the other side of the equation is the earnings. And earnings have been sort of the mother's milk of this rally, really, and they've been fantastic. What was it, 25% plus gain last year, and some double digit expected this year. But I tell you, Catherine, I mean, the conference calls I've been on recently, it's, as you know, with the supply chain issues, higher labor costs, higher input costs in general, and some, worries a little bit about the demand side overall. Margins are at all-time highs, and so earnings growth is getting squeezed a little bit. So, for the point of view of what do you worry about? Well, the two most important things that drive markets could, maybe be turning into headwinds instead of tailwinds. And that worries me, especially when valuations are at all-time highs. So,
Yeah.
And sentiment is pretty bullish too. So yeah, you can't run for the exit. You still have to be in the game to some degree, but how do you play it without getting your head handed back to you?
Yeah, which we'll get to in just one second. But today's market move, right out of the gate, we saw some strong market movements higher. The Nasdaq up over 1%, and yet the U.S. 10-year yield up over 2% and holding. I don't know where it is right now at 308, but nonetheless, it was slightly perplexing to me, but you explain it as how.
Well, you take the two sides of that. I mean, the market balance is the idea that if nothing's happened in the Ukraine, we have to throw some geopolitical, it has been short-term overhang on the market to the degree that the news this morning ameliorates that or sort of lessens that worry in the short term. Of course, you're going to get a bounce in stocks that have sold off pretty dramatically on that news alone. And on the other side of that equation, yeah, that may have slowed down some of the more hawkish views on interest rates that sort of creeped into the market late last week, certainly on Friday when the 10-year slipped back under 2% again. So now it's sort of back to, okay, yeah, the Fed is going to tighten, they're behind the curve, inflation is high, and let's start pushing these yields higher. So I think they're both logical moves. And you always got to pay to be more attention, Catherine, to the last hour than the first hour. The first hour can be anything, positioning from overnight. It's the last hour. That's when sort of the money sort of rides into the close. Where is it? Is it long, that short? Where do you stand? So I mean that's the key to this rally hold into the close today. So
yeah, and it's certainly been some interesting moves for sure. And I wonder as well, with the PPI number coming in at 9.5% today. Now, some people would say it's less important because of less reliance on manufacturing versus CPI. But nonetheless, we're definitely seeing inflation. Having said that, let's talk about one of your top picks, which is in the gold sector. Why is that? And are you looking at this as a bit of an inflation hedge? Most people would turn to Bitcoin for that.
yeah, and you're right. And a lot of people have turned to Bitcoin, and I think that's why gold's underperformed in the past year in an environment where you thought it probably should have done better with inflation starting to become higher, real interest rates extremely negative. But yeah, the golds remind me a little bit. I'm not, going crazy on the golds, but I certainly throw in a few names back into the mix. It remind me a little of the oil stocks 6, 12 months, years ago. First of all, they're trading at multi-decade lows on valuation. These things used to trade at multiples of their NAVs or their net asset values and, double-digit multiples of cash flow. Now you're getting them for 4 times operating cash flow and 50% of their net asset value. So on that basis, they're cheap. And like I say, I think, what has held back gold has been the move into crypto has certainly been a bit of a negative, and the U.S. dollar, as you know, Catherine, it's just been a stalwart. I mean, certainly with interest rates rising in the U.S., that's even drawn more currency there, and that's always a headwind for all commodities, but particularly gold. So that's held back the sector. The stocks have gotten incredibly cheap, and a few of these things may be changing a little bit. U.S. is definitely raising rates, but if the rest of the world you start to get some strengthening, if you start to see the euro in the eurozone and others, you certainly in Canada and Britain, you tighten policy a little bit there. This bloom on the U.S. dollar may come off a little bit. And if that's the case, you'd probably see money flow back into gold as well. So, I like the Agnico in particular because they just bought the Kirkland Lake. The stock's well off on the highs, better, cash flow multiple is traded at for a while. It's got some growth potential there. And like I say, I like that Kirkland Lake gold acquisition they did. So yeah, we're only probably 4% of the portfolio in golds, but I have added a little bit. So.
Nice. And John, I wonder as well, like, look, I'm a big believer in fundamental analysis and buying on fundamentals. I also, of course, like technical analysis. But I also, of course, recognize the market dynamics. And what I mean by that is money flow. And there hasn't been the money flow into these gold stocks. Now, you could say the same for energy. And of course, energy's been on fire and you just had to be patient. Do you think this is going to be the same case for gold? I mean, it's kind of been left to the sidelines, it seems.
Catherine, that's a great point, and it's absolutely true. And if I had a concern, it would be exactly that. Is this more of a permanent move? I mean, is Bitcoin sort of, will that take the place, or cryptos in general, as a store of value, sort of currency irrelevant, politically irrelevant kind of holding as opposed to gold and inflation out? I don't know. This is the first time we're seeing it go through. I think in the short term, it's taken some, potential buying away from it, and certainly. But it's not like the central banks are big holders of cryptos yet or other things. But if you start to move in that direction, yeah, that's a bigger. You will get a permanent impairment of these valuations, and they will stay low, just like you have on the energy stocks. I mean, when these things started trading down to 2 to 3 times operating cash flow, is this the new tobacco world or something like that? That this people will not pay up for these things again.
Yeah. What kind of return expectations can you see in an Agnico Eagle?
In the market, or sorry,
In the
in
stock,
general?
in the stock price.
Oh, you could easily, in a better environment, there's no, this stock had traded down from $90. There's no reason you couldn't see that price again. So, if you got some flows back in, it's becoming a more prominent name because it's big cap, and there's not that, outside of Barrick and Newmont, there's not that many big cap options for international investors. So now you're starting to get a better play there. So it's not unreasonable to see as much as 50% upside. I'm not counting on that, but yeah,
Right.
I think they're way out of favor, and it always surprises me how far things move in either direction. And the energy stocks have been a wake up call to that. They went far lower than I think anyone would have expected, and now they're recovering pretty substantially.
Yeah. Let's take a look at another Canadian name, Lightspeed. I actually interviewed the founder, CEO, Dax De Silva, not that long ago from my other program, The Buck Stops Here, on the news forum. What is it that you like about this company?
Well, it's interesting there, Catherine. I mean, I was worried about that high growth sector and these things trading at 20 times revenues, basically no earnings, no operating cash flows. And now you turn around and a stock drops, and you know the trader in me, Catherine. I said something drops 75% from the peak, and yet you haven't taken anything away from the story. They're still talking about organic growth of over 50% a year, the market positioning, everything else, and suddenly it's trading at 4 to 5 times revenue, and it's closer to generating positive operating cash flow. The business model is still in place. But I got to have a look at that. I mean, it's not to say there may not be more downside here. Could have said the same thing with Peloton, maybe at 60, but it's a different story. It's just that they start to wake you up when these things have come down a long way. And I've seen a lot. I've seen, their PayPal, a lot of stocks have just been absolutely decimated in this environment. And my biggest worry about them had been their valuation, and that's less of a concern now. So, because I think the longer term, the technology story is still where you want to be. In the short term, we're going to move to value. Growth got way overextended and way overbought, and then it checked back. But if I'm looking at investing for for the next 5 or 10 years, looking out like that, the
Yeah.
tech sector is still where you want to be positioned.
Let's just describe briefly what Lightspeed is.
Well, it's a point of sale terminal facilitator. In fact, they started off just, for restaurants and payments, and now they're sort of broadening, their vertical integration as well as the horizontal integration. They're not really moving into a Shopify place, but it's, you're accelerating payments, and obviously they're adding software. It's sort of the buy model as well. You've got a lot of organic growth, but you're also sort of tacking on apps and other things that are going to, help your sort of acquisition driven growth as well. So, it's a combination. It's, they're not alone in the field. There's certainly other players in there. So it's, that's a risk as well as obsolescence or whatever competition on your application. But they've got a good space right now, and they're bringing on customers, and like the internal organic growth rate, like they're still running at over 50%. So.
And speaking of payment systems, let's take a look at another one of your top picks, which is PayPal.
Yeah.
They did just report their earnings a week or two ago. It was met with negative reaction by investors. What was it about the quarter that investors didn't like, and why do you like it?
Well, I guess it was almost everything about the quarters. The expectations, almost like the Facebook Meta thing. It's just the expectations have been so high, and they came in and really talked down, this current year relative. That was just after Visa and Mastercard had produced some pretty good numbers, so people are using your space and all of that. And I just think no, long term, the banking industry, as we know, is going through a metamorphosis, and the old sort of chartered banks have to sort of reinvent their business models to be more electronic payments, transfers, pay as you go kind of thing, payments. And when you look at the positioning of a PayPal or even a Visa and a Mastercard or other players in the system, they're more aligned with that. So their growth is going to be strong. It's just valuations were excessive. PayPal was trading at 40 times earnings multiple, and
Wow.
now it's come down to sort of into the low 20s based on maybe a bit of a more disappointing growth rate. But I don't think anything's changed about the application, the use, the growth in the sector, and there's still sort of a go-to app for payments, and we know. So we're going to electronic payments. That is so, that is so apparent. I look at any of my kids and the way they pay for anything. It's like they do everything else. They do it on their phone and they hold it up. So the idea that you're not moving to a system like this is you're sort of avoiding the obvious. And so you want financial firms that are positioned around that. So for the longer term, I'd rather in the financials area, I'd rather own companies like PayPal and Visa and MasterCard as opposed to the big banks, but not when they're trading at 40 times earnings and the banks are 8 times earnings. Now you've brought those down in, so it's a little more attractive. So
Yeah. It's what's the takeaway lesson, John, as it relates to high valuation stocks? I mean, we know you can get crushed on them. But when you see something like a PayPal going from 40 times to low 20s on a PE multiple, you have to sit there. If you're owning PayPal at 40 times, what do you do with the stock? I mean, I'm assuming you hold it, but it's going to take a while to get back to that kind of valuation if it does.
oh yeah, no, we've got all our little rules. I mean, I certainly go with a lot of people with that 3 day rule. You never buy it on day one when they're down, because most of these things tend to have been, in particularly in technology, overowned, and it takes a while, for people to get to these bigger positions down. And here's one rule of thumb I always use, Catherine. If I didn't own the stock, and had never heard of it, or I did say, well, I didn't have a position in it, for a stock you hold that is dropping. Ask yourself the question, if you didn't own it already, didn't know it, would you buy it at today's price? And if the answer is no, then why do you continue to hold it? So, and I think you get that, we get that a lot. And that's why when those numbers came out initially, the PayPal, we had some on the books. I sold it day one. And then, it's dropped a further 30% since then, 40% since then. And now we're looking at coming back to it. And you just can sort of go through that rule. I like the positioning. I like I say, I like where they are. It's just in the short term, they are overowned, and people, sell now and ask questions later. So you got to, with every stock, the better question you've got in there, Catherine, too, is how do you do with the high valuation stocks? How do you position yourself?
Yeah.
I think you've always got to look, what's your upside of a stock and what's your downside? You really do have to be a risk adjusted rate of return. And I don't think a lot of people go through that full exercise on a stock. They think, yeah, there might be 20% upside, it's still rising. But then you look at it because of the high valuation, there's 70% on the downside. And like I say, you look through the, the DocuSigns and the Pelotons and all of these of the past year, and there's so much evidence of it. There are pot stocks in Canada. You had a bunch of people like myself on during the period when it was all the excitement, and we're all just shaking our heads at the valuation. Yes. It's only when they start to roll over you see, yeah, there really is a lot of downside when you got in such an extended valuation.
But Jen, I just want to recap that for 1 second, because I think that these rules of thumb from someone like yourself are really important. So you're saying that you owned PayPal.
Yeah.
The quarter wasn't great. You said, I guess, with the news you learned during the quarter, if you didn't own it, would you have bought it today? And if not, you would sell it. And so that's why you sold it day one, because that's a hard thing. People will, like, a lot of the time think about it, talk to analysts, but that's the trader in you. You're like, I'm out.
It's a very hard thing, Catherine. It's hard, and for a lot of people, it's the worst, because something is down 20%. And how can I bought the thing at 200, it's trading 150. I'm not going to sell it here. And I'd like to say the question you shouldn't be asking is not, the 200 is irrelevant at that point. The question is at 150. If you didn't own it, would you buy it? And if the answer is no, then sell it, and reassess when it is at a price where you would go around and say, and we did that with PayPal. I think it was up around 230 or something like that. We sold it at 180, and I was buying it back a couple of days ago at 115. It's just
wow.
It just
nice. Nice.
You can't compound. You don't want to compound your errors. You make a lot of errors in this business. On it, don't go out making them worse.
Wow. I hope people are really listening to that, because that's that what you just described and did is years of experience and know-how. So that's huge. Okay. I've only got about 4 minutes left. I love this 2020, 20 minutes, top 5 at 5:20. But the next one, let's actually, you have another Canadian one, CI Financial.
Yeah, you know what? And I don't have a lot in that space. I don't have a lot in the financials right now, but we recently sold out of the bank. Say that's such a great run. I was looking for positioning elsewhere. And CI, and I've always, they have sort of been the Cadillac player of the industry, lowest cost structure, a lot of growth acquisitions. They're doing more of the counselor acquisitions now in the US.
Yeah.
tremendous operating cash flow, and using most of the cash flow to buy back their own stock. When I started the business back in 1993, Catherine, CI was my first client, so I know these guys well. Bill Holland's still not operating on a daily basis. I was noticing Bill was out there continually personally to buy the stock. It's one thing when companies go out and buy the stock. This is a board decision and using the company bank to sort of buy into this. It's when investors personally put money in. That's always to me a more positive side. On CI, a lot of insider buying directly. So that's a positive. Like I say, the operating cash flow multiple stocks come up with 30% off from I think it traded up near $30. We were buying it around 22 the other day. So that is, again, just to me attractive on the valuation and at least on a trading basis. So.
Yeah, it's had a really nice run, and I feel like the CEO has, I mean, I've interviewed him going back a number of years ago when, he did describe the strategy that they were going to be going out and buying these councils, smaller investment firms in the United States, and they've been doing that, and it's been met well by the street in terms of stock reaction. But it's important, I think, John, to understand their approach doing that versus almost being a traditional asset manager via mutual funds, which would have been their original business, still is their business, because that's been a tough business.
Yeah, and a lot of companies, you've seen a lot of industries now where companies have to reposition themselves because their traditional businesses are dying. You could say on GM with going from, internal combustion to electric vehicles, you got to do the transition, even if you're sort of spinning your wheels in short term. Yeah, see, I mean, and all the mutual fund companies, the mutual fund business itself really is dying. I mean, the high fee business, the structure of it, I just don't think, maybe it's a slow death and all of that. It's not a growth industry. ETFs are providing a lower cost alternative. Most younger people nowadays, they're not going to pay the fees that were paid in the past. Market returns aren't going to give you that advantage. So these guys are shifting away from that business to, the counseling business more directly. So a higher margin, and it makes sense of the strategy. Sometimes in the short term, like I say, you're spinning your wheels because you got a legacy business you're rolling out of, a growth business you're rolling into, and in the short term, you may not get as much traction out of it, but you need to do the transition.
Yeah, absolutely. And you did mention the name, so this is your last top pick, and it's GM.
Yeah, that's to me, it's just like, I don't know, it's crazy when I shake my head at that. When Rivian and Lucid traded with bigger valuations, with no production than GM that produces 7.5 million vehicles a year. I just think, 7 times earnings right now. They're doing the transition into the electrical vehicles. They got the cash to do it. They got 100 years of auto production experience. They know the distribution network. And I just think between the valuation, the transition over, I thought this stock is just crazy cheap. And so yeah, it's not, like I say, they will have to transition well through that business, but these guys are positioned as well, and the market's just not paying for it. Plus, it's a pent-up demand for automobiles right now because of the chip shortage. These guys had a much tougher year last year, the whole industry, than anyone thought they would. And they haven't sold as many automobiles, not because there's not the demand for it, because they can't get the chips to build them. That's why used car prices are going through the roof. I think as you start to get through those problems and they start to build more vehicles again, that's going to flow right to earnings at a higher margin. And, there's going to be a ready market for it. So, I mean, there's a lot of reasons I like this.
But John, I would think that the stock right now at 7 times on a PE basis should start to discount and reflect the improvement in the world, and therefore the chip shortages as well, as it relates to hopefully Omicron has been peaking, we hope. I mean, obviously we're still not even close to where we were in terms of the reopening trade occurring, but I'm surprised that it's still trading at these levels.
Me too. You and I both. I mean, we added more recently. Some people are upset with the quarter and all of that, but yeah, they're going to do this transition. There's going to be some hiccups along the way, and clearly the chip shortage is hurting in the short term. I mean, the sort of the border blockage last week probably didn't help the auto industry.
Yeah,
we'll get through this. The demand is out there. The demand for autos, and that's why used car prices are going through the roof, and there's nothing in the showrooms or on the lots right now. But that just means they got the pent up production ready to go, and they got electric vehicles, and they got the brand names. Let's face it. I mean, yeah, Tesla is owning this industry right now, but GM's going to come through. Obviously, with the SUVs, with the Hummers, all the things like that. They're just going to take their brand names, just like Ford will, and apply them to the new electrical vehicles. You got to roll out of that internal combustion engine market, but you got the cash flow from that side to fund your growth on the electrical vehicle side. So
Yeah. Okay. All right, John, that was great. Amazing. Thank you very, very much.
All right, always a pleasure, Catherine.